Hello, everyone, and welcome back to the GMS Weekly podcast, where we break down the key developments shaping the global ship recycling markets.
It's week 20 of 2026, and this week the market moved from cautious optimism back into hard reality.
Exactly. Last week, the big question was whether diplomacy could release tonnage in time.
And this week the answer from the market appears to be no.
The diplomatic momentum that briefly pushed Brent down below $100 has stalled. President Trump publicly rejected Iran's counterproposal on May 12th, warning that the ceasefire was effectively on life support.
And almost immediately the oil market reversed course. Brent rallied back above $107 per barrel, while WTI climbed back above 102.
Which tells you the war premium never really disappeared. It simply paused for a week.
Exactly, the market now sees the geopolitical risk as structural again, not temporary.
Saudi Aramco's CEO also added a major warning this week, saying the oil market may not normalize until 2027 if Hormuz remains disrupted beyond mid-June.
That's a remarkable statement because it pushes the timeline far beyond a short-term shipping disruption.
And the International Energy Agency reinforced the same message, confirming that global oil inventories have been falling at record pace.
So even under a more constructive diplomatic scenario, the market still looks undersupplied through at least October's.
Which brings us directly back to ship recycling.
Exactly. Because when oil remains elevated and freight remains strong, owners continue making the same decision. Keep trading older vessels.
And freight has only strengthened that logic this week.
The Baltic Dry Index broke through 3,000 before consolidating, while Capesize earnings moved above $43,000 per day.
Panamax earnings also strengthened, and dry bulk returns are now at some of the strongest levels we've seen this year.
Which is critical because those are exactly the segments feeding potential recycling candidates.
So the economics still favor trading over beaching.
And that's why the backlog we've been discussing since Q1 has now become deeply entrenched.
Exactly. This is no longer a temporary delay in recycling supply. The backlog has hardened into structure.
And with only about 2 weeks left before the practical monsoon closure in the subcontinent, the timing pressure is becoming severe.
Let's move into the individual recycling markets, starting with Bangladesh.
Bangladesh remains in a very strong operational position. The taka has held remarkably steady around 122.9 against the dollar, despite all the volatility in oil and freight.
That stability is important because it has allowed local pricing to remain competitive. Steel plate prices in Bangladesh are still sitting roughly between $562 and $578 per ton.
Which keeps Chattogram firmly ahead of along and still very competitive regionally.
The other important point is that the letter of credit pipeline continues functioning smoothly. The financing friction that defined the first quarter has now been absent for several weeks.
So financially and operationally, Bangladesh is probably in its strongest position since the crisis began.
But again, the problem is not demand.
Its supply.
Exactly. The yards want ships. Financing is working. Buyers are active, but owners continue holding onto vessels because freight earnings remain too attractive.
Bangladesh is also still waiting for its April inflation print, which now carries added importance after the inflation shocks we've already seen in Pakistan and Turkey.
But for now, the overall picture remains unchanged. Stable currency, operational buyers, tight supply.
Moving to India this week was once again dominated by the rupee.
Yes, the Indian rupee broke to yet another all-time low, touching around 95.71 against the dollar.
And notably, the Reserve Bank of India has remained relatively restrained in its intervention.
Which suggests the market is increasingly pricing in a prolonged energy disruption scenario, rather than a temporary shock.
Especially because India remains heavily dependent on Hormuz-linked crude and LPG flows.
Exactly. And when Brent rebounds above $107, while the IEA warns of continued undersupply, the pressure on India's import bill becomes very difficult to ignore.
On the recycling side, long steel plate prices softened slightly into the low 400s in dollar terms.
Which keeps India as the lowest price destination in the subcontinent.
But India's core strength still remains compliance.
Absolutely. More than 110 yards continue to hold valid statements of compliance, which keeps the long highly relevant for regulated tonnage.
But once again, none of the structural advantages matter if ships are not arriving.
Exactly. The rupee weakness has not released tonnage. The Brent rebound has not released tonnage. Nothing this week has changed the supply picture.
Pakistan, meanwhile, had one of the more interesting currency stories this week.
Very much so. While the rupee in India weakened further, and the Turkish lira stayed near record lows, Pakistan's rupee actually firmed slightly.
Which is quite remarkable considering the inflation shock Pakistan absorbed recently.
The market appears to be responding positively to the state bank's 100 basis point rate hike and tighter monetary stance.
Pakistan's inflation remains elevated, of course. April CPI at 10.9% is still a major concern.
But the currency stabilization has helped Ghadani recover some of the positioning pressure it faced last week.
And pricing in Pakistan remains extremely firm, still among the strongest in the market.
Exactly. Pakistan's Gulf proximity advantage remains highly relevant while Hormuz uncertainty continues.
But the same operational problem still applies here as well.
Right. The yards are ready, the pricing is there, the certified capacity exists. But there are simply not enough recycling candidates entering the market before monsoon.
Finally, Turkey continues operating in a completely different pricing environment from the subcontinent.
The Turkish lira has stabilized near record weakness around 45.24 against the dollar, while inflation continues moving higher.
Turkey's April inflation print above 32% effectively ended the disinflation narrative that had been developing earlier this year.
But despite the weaker currency, Aliaga remains structurally uncompetitive for mainstream tonnage.
Prices there remain far below the subcontinent, roughly in the $270 to $290 per LDT range depending on vessel type.
Which means Turkey's role continues to focus almost entirely on EU-regulated vessels where compliance outweighs price.
So stepping back, the market message this week is becoming increasingly clear.
Diplomacy has stalled, oil has rebounded, freight remains extremely firm, and the monsoon clock is ticking.
Which means the expected release of recycling supply still has not arrived.
Exactly. The market spent several weeks asking whether the Q1 overhang would become a Q2 backlog.
And now the answer is yes.
The backlog has hardened.
The next 2 weeks are now critical because the monsoon window will close regardless of whether diplomacy progresses.
And based on current freight economics and continued uncertainty around Hormuz, owners still appear more willing to trade vessels than recycle them.
That's all for this week's update on the global ship recycling markets.
We'll be back next week with more insights.
Until then, stay safe.
And see you next week.